Hi, I'm Mike Turner. I've developed a set of rules. I call them my 10 must-follow rules for beating the market. Rule number 4 is probably the most important rule of the 10 rules. It's all about timing when to get out, when to sell. And I'm going to take you through kind of maybe some questions here that I want you to think about as I go through it as to how you go about buying a stock today. Maybe you buy a stock because it's got great fundamentals. Maybe you buy it because it's got great technicals. Maybe you've heard it pumped on one of the TV shows, or the talking heads have talked about it. Maybe you've read about it in a trade magazine. Maybe one of your friends has said to you, this is a great stock. I know the people on the inside of the company and they're buying shares. This is a great stock to own. And you think of all of these reasons to buy a stock. In fact, I want you to think about right now, why do you buy a stock? Why do you ever buy a stock? Now, when I ask that question, and I ask it often when I talk to large groups of investors, I get lots of interesting questions or answers back. Most will say, well, I buy a stock to make money. And that's a fairly reasonable answer. But that's not the answer I'm looking for, and it's not the answer that you're going to expect to hear from me. And this is the thing that's very unique about what I do, and is one of the key elements for how you make serious money in the stock market. The primary reason to buy a stock is to sell it. Now I want to repeat that. The primary reason to buy a stock is to sell it. After all, you don't make any money by buying a stock. In fact, think about this. No one has ever made a dime by buying the right stock at the right time. And yet you spend all of your time trying to find the stock to buy and when to buy it, and you do all of this research because that's exactly what you want to do. You want to, and most investors want to, buy the right stock at the right time because they feel that if they can buy the right stock at the right time, they will make a lot of money. But really what they're wanting to do is to sell that stock, that right stock, at the right time. And this is where rule number 4 comes into play. Now, over the past few years, I'm sure you have seen people who've made a lot of money and lost a lot of money. And I want you to think about your own investment in the market. Maybe you're a new investor. Maybe you've been investing for decades. But one thing that all investors learn one way or the other is that one time or another is that they'll either hold on to a stock too long or they'll get out too early, but more times than not, they get out too late. They buy a stock at, let's just say they buy a stock at $30 a share. And sure enough, it goes up to 35, and they're happy. Then it goes up to 40. They're very happy. Then it doubles. It goes up to 60. Now they're bragging about it. They're really smart investors. They start telling their friends, their significant other, how great a stock picker that they are. Maybe it even goes up to 70 or 80. Maybe it's a triple. Maybe it goes up to 90. And they think, what? There's nothing hard about making money in the stock market. And then that stock begins to come down. It drops to 80. Well, they're still way up. It's still got great fundamentals. They're not going to sell it. Maybe it drops back down to 60. Well, they're not as happy as they were as when it was at 90, but they've still doubled. They're still not unhappy with their choice. Then something really bizarre happens and the stock drops all the way back down to 30. And they're sick about that, but they're saying to themselves, well, the stock's still a great company. I still love this company. I love their products. They got great products in the pipeline. I really want to hang on to this. Then it drops down to 20. Then it drops down to 15. And no longer now are they talking to their friends about their great prowess as being a great stock picker. Now they're beginning to kind of have a difficult time even sleeping at night thinking about this stock. Maybe they had a lot of money tied up in that stock. And so what do too many investors do right there? They say, well, this stock is still a great stock. I think it's going to go back to 30. It'll probably at least go back to 60. I'm going to double down. I'm going to go out and buy the same number of shares again at $15 that I bought at $30 so that I can average my cost down. And so they will buy more shares. They will look at lowering their net cost in that stock, hoping that when it does go back up to 30, they'll make their money back, or when it goes back to 40, they can get out. But they're just second guessing. And one of the things that I strongly, strongly recommend is never average down. That's what that's called, averaging down. And I don't mean to be insulting to anybody watching this tape, but the only reason I have ever seen for an investor to average down is to just assuage their ego. That they believe that they picked the right stock and that the market is wrong, and that if they'll just average their costs down, they'll eventually come back and they'll make money on their trade because they made the right decision. They're still trying to make that, convince themselves that they were smart and they made the right decision. Well, here's maybe a surprise to you about this. The market's never wrong. If you're not making money in the market, you're the one that's wrong. So the key here is to know when to get out of a stock. And I have developed a formula for doing that. And what I do is this, and I'm going to pull this formula up on the screen here so you can look at it. What I do is I calculate how much that stock is likely to move up or down in the upcoming 5 trading days. And then I subtract that amount from last week's lowest low, and that becomes my stop loss. And then as the stock moves up week after week, or maybe even goes down some, moves back up, that stop loss stair steps. Then when that stock gets to a certain point and begins to come back down, it'll trigger that stop loss and I'm out. I have a rule for how I get out. The rule is based upon how much that stock's volatility has moved over the past year. So every stock has got its own personality of movement. I know you've probably heard that maybe a certain fixed percentage is what you should have for a stop loss. Some of you don't even believe in stop losses at all. What I believe in, and what works extremely well, is to develop a stop loss that is tied to the volatility of that stock historically, and then project how much it's going to move in the upcoming week and how much it can move against me and still be in an uptrend. Now that's a key element. I want to know how much a stock can move against me or move down if I'm long in it in the upcoming 5 trading days and still be in an uptrend. And this formula will do it. It's called my stop loss rule. It's an extremely important formula, and you should really follow it to know when to get out of a stock anytime that you buy one.